Welcome to our participants for joining in this next segment of today's webcast. In this segment, Dharma and I will be discussing the state of the markets and the shape of things to come. So to start off, Dharma and I wanted to address probably what is the most common question that we hear from clients. And the question goes something like this. Are markets currently being resilient or are they being delusional? How do we explain this large discrepancy between the real economy and what the markets are behaving? I think most of you are aware that in order to explain the path of the recovery, most economists around the world tend to use letters to describe the shape of the recovery path. I think you've frequently heard references to V shapes or U shapes. But at UOB Asset Management, for the past quarter, we've been using the square root shape as a description of what we're expecting over in this recovery. And so Dharma, I wanted to address this to you. You were the one who initially brought the square root theory idea up to the strategy committee, and we've been using it ever since. So how about, Dharma, can I turn to you and ask you to summarize some of the key points of the square root theory? I usually highlight that in this slide that you can see on your screen here, I usually use it to explain to clients that big discrepancy we have between what I would describe here as the green dotted line of the economy and the blue line of the market. And obviously, so what we're arguing is that there can be this big divergence. And what we try to usually highlight is that this point Z in the future is the point where at some point the global economy will return to the level of activity seen before the crisis. And from that point then, what markets will do is they'll just discount back to the current time period versus the economy. Well, the economy has to go on its stated path. So hence, we get this big divergence. I usually point out a couple things. One, this blue path tends to go in accordance to what I would call futures pricing theory. I usually highlight to clients that when I was in university, I took a derivatives course. And when I took this derivatives course, I, before that, had always assumed that, a futures price, the price that the markets expect the values to be in 1 month, and the current price is what we think the values are today. But I remember my professor scolding me. He said, no, silly, if you think the markets are going to go up 1 month in the future, you won't wait for 1 month. The markets will go up now. And the only difference between that future price and the current price is the discounted value of money, or in this case, it should be discounted at the cost of equity. So hence, I think that kind of explains this path a bit. And while it's a little bit surprising then to get this divergence in the economy and equities, this is logically how equities should be sort of priced in this type of event. And another point I usually highlight is that in many ways, I find this has been more intuitive to retail investors than it has been to professional fund managers like myself. I find when I talk to retail clients, say that, well, I do expect that eventually we'll recover from COVID. And if there's a 20% decline in markets, it might take a year or two, but I'll buy and wait for that. Where I think it's the professional fund managers that expected this blue line to track the green line more closely, because we watch markets all the time, and we usually see a tighter correlation, and this big discrepancy doesn't make a lot of sense. Then finally, I would say the next most important part of this theory is point Z in the future. Point Z becomes the part where we discount back to. And so estimating when part of point when we return to pre-crisis levels is critical. And yet, of course, it's very hard to estimate that with all the uncertainties in the world. At UOB Asset Management, our base case assumption is that recovery we get back to that level of economic activity by the half of 2021. And at that point, then it becomes the part where we discount back from. We would also highlight that in this next slide that you can see that our view in that the level of economic activity returns to pre-crisis levels by the second half of 21 is pretty similar to what most analyst forecasts are doing right now too. So for example, if you look at this chart, you see the forecasted quarterly earnings for the S&P 500. And what you see is the analysts are expecting that earnings to get back to pre-crisis levels by around the third quarter of 2020. Of course, there's a lot of uncertainties about that, but to sort of gauge more on when we get that recovery, we tend to do two things. We, one, look at our views on the shape of the recovery, which is also square root shape. And also we think a lot about the vaccine. So Darmo, I'm going to hope that we've sorted the technical problems and that I'm going to ask you to cover the description of why the economic path as well as this market path should end up having a bit of a square root shape as well.
Okay. Basically, I think, as I was trying to explain just now, when COVID first started, what happened was, of course, we had sort of lockdown all across the world, and economic activity basically sort of simply plunged and sort of cratered. And after that, basically, what we had was that government around the world did a lot of pump priming. They sort of printed lots of money and pumped liquidity into the banking system. And also they basically subsidized a lot of business costs and personal income to make sure that we don't get systemic bankruptcy around the world. And after that, what happened was that as unlocking begins for the economy, and we see sort of gradually the economy were unlocking, whether in China, and then now we see the unlocking of states in the US in early June. What happened is that we are seeing sort of a rebound in economic activity simply because of that pent-up demand. I mean, people have been locked down in their houses for a month or two. The first thing you want to do is go out and have a nice dinner in a restaurant and things like that. So you see this pent-up demand being released, and economic activity would actually pick up very, very quickly. But I think after that, what's likely to happen is that what we expect is that after that, things begin to taper off, because ultimately there are still people who are skeptical. There are still people who are worried about the virus. You hear sort of stories about, or comments, people say that the economy is unlocking because they're unlocking because of the economy, not because it's safe, comments like that. So basically, there's still a lot of skepticism, and because of that, and also because the need of social distancing and some activities simply cannot come back. For example, air travel or tourism basically cannot really recover. And because of that, what we are going to see is that economic activity will start to flatten out at sort of below the pre-COVID level, which is why I think, we come sort of the square root shape starts to take shape in terms of economic activity as well. I think this slide actually shows foot traffic in the US in shopping malls, right? So basically what happened was that we saw a collapse because of a lockdown, and then after that we saw a gradual pickup in activity, gradual pickup in foot traffic as people go back to the malls and shop. But since mid-June, basically this, because of the pickup in new COVID cases in the US, actually there's probably a bit more sentiments gets affected, consumer sentiments get affected, and basically we are starting to see sort of a flattening out of the foot traffic in shopping malls in the US. And this sort of data is actually being seen in quite a number of areas as well. For example, in restaurant bookings, we see sort of the same pattern. It was a collapse and then gradual pickup, and then after that sort of flattening out. We see that in sort of small business hours, in retail sales. So basically we see in quite a number of this data, especially this high frequency data, that the sort of rate of improvement has sort of stalled, and we are now probably operating at sort of sub-pre-COVID level. I think there's a term that some people coin it called the 90% economy, that businesses are actually now operating at suboptimal level. Tony?
So then I think we frequently discussed at this point, in order to get from that 90% recovery to more of a full recovery, we do think we need progress in treatments and vaccines. As much as I think there's been progress around the world and the economy is bouncing back, it doesn't quite feel like things will get back to completely normal. So on this front, I guess, I think it's incumbent upon every investor to have a view on what is probably the most defining characteristic of the path of the virus and the vaccine. And so as an investor like myself, I find, I study and I read far more science journals nowadays than I do finance journals, as I may usually. And given all this, I don't really think anyone should turn to us as investors for real clear guidance on the scientific breakthroughs. But I think what is incumbent upon us is to have a view of how to interpret two things. One, how do we think about these odds and the impact of market probabilities and how should it be priced? And then also, how does this stand relative to consensus? So we have a couple of charts on this that sort of highlights some of our thoughts. And the bottom line, I would say, for clients is I would say that our bottom line view is we actually think that the odds of a vaccine are fairly high. Our view is that more likely than not, by the end of this year or beginning of next year, we will have a vaccine and treatment improvements that will help address this pandemic crisis. Again, all we can do is sort of interpret the scientific comments into sort of market odds. But I think one way I would put it is I really think if we had some of these experts around the world, if we had an Anthony Fauci, and I asked him, I'll give you $1,000 if you get this question correct. Will the vaccine come out before the end of the year or after the end of the year? I've listened to countless number of his presentations, and for the math, I think for the most likely he would take the bet that we're going to get a vaccine before the end of this year. And so a couple other ways I highlighted to clients is the charts on this slide that you see in front of you. The chart on the left highlights the success rate of drugs after they get to phase 3 trials. And what you can see is by the time they get to phase 3 trials, they have about a 60% likelihood of being approved for usage. And since there are currently 6 vaccines in phase 3 trials, one way to look at this is just the mathematics of it is if you take a 40% chance of failure to the power of 6, you actually get a mathematical probability of about 1% that we won't have the vaccine. I don't really think it's that high, but I'm comfortable with, better than 50% type odds that we're going to have a vaccine. And then on the chart on the right, I would argue that I don't think this is fully priced into the markets, that the chart on the right shows surveys, this is from the Wall Street Journal, and I've seen several others, and they frequently show that the expectation for a vaccine is really not until the end of 2021 or even 2022. So again, our overall market view is that the global economy can really kind of get back to sort of the 100% level by the end of 2021. And part of our thinking is the fact that I think we're a little bit more positive on the odds of a vaccine than the market. But saying all that positive talk, let me turn to you, Darmo, and maybe you can talk me down a bit from my optimism. I know there are points of warning we should highlight as well to clients. Maybe you can cover those.
Yeah. So basically playing the devil advocates, we see that, for example, there's a lot of skepticism in terms of the vaccine as to, given that this vaccine is produced or developed in such short period of time. I mean, we know that usually vaccines take years and years to develop. This one is actually rushed out in less than a year. That's probably a record if we ever have one. I think there's actually a lot of skepticism in terms of how safe the vaccine is, whether there's going to be any side effect or after effects. And a lot of people may actually adopt a wait and see attitude to this vaccine. And basically because of that, if we don't get sort of the majority of the population being vaccinated, then basically the vaccine is not effective because you don't have enough people vaccinated for this virus. So I think that's probably the first point that could really derail our hypothesis. The second part is of course whether the vaccine is effective on the most vulnerable group of people, the group of people that probably needs the most protection, the elderly and those who have pre-existing medical condition. And I think we don't have a clear answer to that. But if the vaccine doesn't help those vulnerable group and death rate remains high after the vaccine, I think there's probably going to be a lot of concern whether the vaccine really means anything for the society at large.
So let's take this assumption then, which I think is fair enough, that I think we're probably going to get positive news on a vaccine. But there are cautions that it's not necessarily the silver bullet that solves everything, but goes a long way. I would also add that the progress on treatments, I think, has been encouraging as well. I think many of you who have followed it, there's the steroids that have helped the more advanced cases. There's the remdesivir that helps on the early stages. And now there's the trial on the interferon beta, which is really encouraging, can help at all stages. And so little by little, things like this, and even just sort of basic care like proning people and using ventilators less, all seem to be contributing to better treatment. But in the end, let's put this together and provide how we interpret this then into our market views. So on this next slide, we have a summary of our various positionings and our overweights and underweights. So let me start off first and summarize the equity positions, and then Dharma, I'll turn to you to summarize the fixed income views. So firstly, when it comes to equities, our view is that we're, as much as we've been positive in what we've been saying, and we think that the market rally has been justified, and we don't really think it's fair to call it a bubble, but that's irrational. Nevertheless, it's rallied enough, and we're close enough to pre-crisis levels that we think we're getting close to the sort of flat part of a square root. So we would argue it's justified, but in the end, we're just sort of neutral on equities because we see them as fully valued at this stage, where we don't think you have to sell them. We don't really believe in a correction back to the March lows or anything like that, but end up being more neutral. The other point we would make is that around the world, we think there's various opportunities. Our preferences have been to overweight the US and to overweight Asia. We like the US because it tends to have the most policy ammunition around the world, and as much as I think the US has handled the crisis poorly, for the most part, they still kind of have the most ammunition. And additionally, they tend to have the companies, the listed companies that have sort of the most dynamic growth opportunities. And therefore, it's another reason we still find that we keep overweighting the US. Then in the case of Asia, we do think that economies like China in particular, which have dealt with the crisis first and tend to show that they're already rebounding to levels of economic activity that are similar to pre-crisis levels, I think sort of bodes well that they are be a leader in terms of just the sheer economic momentum, whereas we tend to be more underweight Europe and Japan. So if that's our equity positioning, let me turn it over to you, Dharma, because in fact, I think one of our key investment opportunities has been in the fixed income space. Can you summarize that, please?
Sure. Well, maybe I'll just add on my 2 cents worth on the equity outlook as well. I think what we are concerned with as well is that there's actually a wide spectrum of outcome. I think things could actually market could actually rally harder if sort of the vaccine comes out earlier, or we get sort of positive news out of the vaccine. But on the other hand, it could actually take sort of another dip if, say, we have a huge second wave that causes lockdowns or causes sort of massive bankruptcies, business failures. So those are actually what we see is actually a wide spectrum of outcome. And because of that, we think that going forward for the next 6 months, market could be a bit volatile. And therefore, we rather stay neutral on equity because both the upside and downside are actually could actually be fairly substantial. I think that's my 2 cents worth on the equity side. And on the fixed income side, basically, therefore, we are actually more positive on fixed income. We don't like government bonds because we think that rates have gone down so low that at this moment there's really very little returns to be get from government bonds. And if anything, if we see sort of the recovery happens next year and interest rates starts rising because of that expectation, then actually we actually may have some negative return from government bonds, which is why we actually underweight government bonds. But where we like is really on the high grade credits or high grade corporate bonds, because at this moment there's still yield pickup to be had from high grade corporates, and spreads are actually still wider than pre-COVID levels. So if things continue along the trajectory that we project, then basically we expect that spread to start compressing, that credit spread to start compressing, and therefore what we are getting is both the yield and some capital gains out of it. So on a sort of risk return basis, is probably one of the asset class that we really like. The last thing is basically on high yield, because we think equities may be a bit volatile, so we also believe that high yield may not be the place to be, because high yield tends to have a strong correlation to equities, and therefore we sort of maintain a neutral position on our high yield recommendation. Tony?
Okay, thanks. And I guess I would just wrap up our overall positioning. I would highlight that within commodities we're neutral, but there is a clear bias within that segments like oil we think are going to take longer to recover, whereas areas like gold really are a pretty logical part of portfolios now. Even at these prices that we've seen this rally over the last few weeks, we continue to argue that at this stage, that especially over the coming year, gold doesn't have a lot of downside. Gold in the previous crisis, in the past decade, didn't really start to weaken until the Fed started to taper QE. And we really think we're a long way from that. And there's still the upside potential in gold if, in fact, we do see inflationary issues over the coming years. And then finally, other areas like alternatives we like as if they're more market neutral and looking for alpha opportunities. There's a lot of dispersion in the markets now. And finally, cash rates are so low that we're underweight cash. So I think that gives an overall summary of our views and the big picture on how we get there. I think I wanted to save time then to get to questions. I think you all have the ability to keep typing in questions, and I think many of you have already sent in preliminary questions. So Dharma, let me turn to some of these questions, and let's cover them for our audience. So one of the questions that I've seen come up in the preliminary questions that were sent in, I saw a lot of references to valuations. And so I guess my first question maybe you can address is, do we think these markets are overvalued? And I guess a common question is, are equities a bubble?
I think it depends on how you measure valuation, right? So if you're looking at earnings, basically what we've seen is that earnings, everyone knows that earnings is going to be really bad this year. And then even next year, if you're talking about sort of a gradual recovery, we might not see full year. We might not see earnings for the whole of 2021 being spectacular. In fact, if we only expect activity to go back to pre-COVID level in the fourth quarter or late in 2021, then basically, if you follow that gradual trajectory, next year's earnings is probably still going to be lower than 2019 earnings. And so with that sort of backdrop, if you look at valuation based on earnings, it's going to look expensive, right? So, but if you look at the sort of comparing equities valuation as equities as an asset class and its valuation versus other asset class like bonds or like cash, then basically equities is actually still relatively attractive. What we are seeing is that equities yield, earnings yield, is compared to, say, real interest rate in terms of real risk-free rate in terms of government bond, we actually have 300-400 basis points of spread there. And actually that's sort of roughly speaking, is sort of a long-term average, if not slightly sort of higher than long-term average. So compared to bonds or risk-free rate, equities actually is not expensive, and that basically I think that's points to, I think, some of the commentary of Tina, or there is no alternative, meaning that if you don't invest in equities, there's really very little areas that you can get a sort of decent yield or decent return on your investment. So I think, relatively speaking, compared to cash rate, compared to risk-free rate, equities definitely is not expensive. And if you look at it even on a price-to-book basis, in most places, in most part of the world, it's actually still not expensive. We may be, in some places, it might be one standard deviation above, but I think that's still within reasonable spectrum. But in a lot of areas, it's actually sort of around long-term average, or some of it is actually even below long-term average.
Okay, I think we're using a lot of our time, but let's try to get to some of these questions. How about one? I see a question here. I think it worries that we may divert from the presentation, but it's asking about the US-China relationship and how it's going to affect the recovery. That one we've discussed a lot in the markets. And, I think also somewhat related to this question I saw in the pre-questions, where there's a question about the U.S. elections and how that's going to play both in terms of the U.S.-China tensions, but also just risks to the markets. So let me make a quick comment on that. Later on in the webcast, Mark and Watson are going to comment on the China market. But I think something that they'll probably highlight, and we've been talking about in our meetings internally, that we do notice that the China market in particular has become much less reactive to these tensions as when they come up. It was over the past year or two, every time there was threats of new tariffs, the China equities in particular would really suffer. They seem to be ignoring all this news more now. Nevertheless, we don't really dismiss what's going on as being something that isn't worthy of concern. The tensions that are going on do seem to keep being elevated, and I think do have the potential to get worse. Obviously, they do seem related to the election. In particular, I think Trump is using them for political reasons. So that gets the other part of the question. And I specifically saw the question about what are our expectations about the election and what may happen afterwards. And so a quick summary is I think it's very fair to say that by all the sort of polling surveys that Biden is clearly ahead by a fairly significant margin. However, we're still 3 months away from the election. And I think the quick summary is if you had the election today, Biden would have a very high chance of winning. But the fact is things can change over the next 3 months. And I guess in particular, we're looking for, can things get better on the pandemic, and can Biden mess up maybe in debates or somehow undermine his strength right now? Other than that, he's probably in a strong position. And then a final point would then be tied to the U.S.-China tensions is the Democrats have always been more of a protectionist type party. But over the last decade or so, they've tried to be more pro-growth and therefore have tried to work on deals that are labor-friendly, but also sort of free trade-friendly, and trying to have it both ways. I think those days are probably over for the Democrat Party. Now that Trump has sort of run around them on this issue, I think they go back to being a little bit more protectionist like they have. But nevertheless, for the U.S.-China tensions, it's our assumption that a Biden presidency won't be as disruptive as a Trump presidency, and will probably kind of more on a long-term basis. And then I guess just finally, there are probably other risks associated with if the Democrats not only take the presidency, but take all of Congress. There's probably some more liberal policies than we've seen in the past, and I think there'll be concerns about the deficit and so forth. So there can be some downsides. But on the other hand, markets did well under Obama, and I think to some degree Biden will be considered an extension of the Obama presidency. So I think we've used up our time here. Dharma, I'm going to wrap it up here, and I'm going to turn it back to Joy, who I think will continue on then with this webcast. Thank you, everyone.
Okay. Thanks, Tony.